encouraging for the market to be able to put some distance between itself and the Friday lows, which were the lows for this move, down 15% from the highs in just 7 days, right? So that's positive. The issue is if your premise is, okay, let's consider that the low, you're now 9% above it, right? So you're kind of toggling around. I think on an abstract way, it's not necessarily the healthiest market tone to go up and down 4% a day, but it is understandable given how stressed and washed out the market was. The best explanation for today was the news hasn't gotten bad enough quickly enough to keep a washed out market from bouncing in this fashion today.
And Mike, to that point, and we slightly touched on this when you weren't on the set earlier, and the time frame is important,
yes.
We have rallied far, far harder here in the US, either this week or since the intraday low on Friday, than around the rest of the world.
It is true. It was a much more concentrated decline, though, so I do think it had, and arguably we came from a more richly valued position at the highs,
and we've had a 50 basis rate.
So it's hard to necessarily see if it's enough or it's too much or we have more to go. I do think it's important to keep in mind, though, we just round trip to last Tuesday. Literally, that's what we did in 6 trading days, went nowhere, but traveled thousands of Dow points along the way.
Is there some sort of hat associated with that?
I don't know, exactly.
Okay.
I think the question is why? Is it fundamentally justified? In other words, has the news been, I don't know, calmer as it relates to the coronavirus fears? Or is it just that the stimulus is coming from now every corner of the globe from central banks?
Well, here's what we're telling clients. It's not that long ago. You don't need a really long memory to go back to the 18-month period of zero forward progress for the market. Began in February 2018 with the onset of the trade war. You were not making a new record high until the fall of 2019. It's a year and a half of big ups, big downs, lots of volatility along the way. And I don't know if you remember this, but just like you see the market lurch up and down on new cases of coronavirus, we were doing the same thing on China might have lunch with Larry Kudlow. Like, we have seen this before. Don't fall out of your chair if we have these big rallies right back up to the top of the range and then, oh no, they're canceling opening day of baseball. Sorry, Mike. Or something to that effect. So I'm just saying, like, calm down. You don't have to have an opinion on every 4% up or down. You certainly don't have to express your opinion on your brokerage account. See what happens. Let things develop. Maybe do some buying on the worst days. Maybe lighten up a little bit on the best days. And remind yourself, we've seen multiple year periods of no progress, lots of volatility. It does happen.
Alicia, where are you standing on all of this at the moment?
So I think I'd have to agree with Josh here. I find it very...
All right, that's it. You're all good now.
We're done.
Okay.
Look, I find it really hard to believe that at some point we're not going to retest some of those lows that we saw on Friday, just because aside from what happened at the end of 2018 and 2019, which was a true V-shaped recovery, as Mike has been telling us today, normally you get some back and fill and some testing, and we are really in front of some of the worst news going forward in the sense of maybe schools closing down or firms preparing for workers to work from home, really depressing demand in the U.S. So you saw those headlines that we haven't had yet.
What level of bad news? Because as Mike said, we are 8 or 9% above Friday's intraday low. So what takes us back down to that level?
Look, I think something where you have some sort of actual attempt at containment in a municipality, a school district, something like that. Not that we're going to become China, but if there's a real attempt to contain this thing, because it's clearly contagious, right? We see it's contagious. If there's an attempt to contain this through containing economic activity, that's really the worst case scenario. Right now, the market is pricing in GDP in this country of more or less around 1%, maybe 1.1, 1.3, but that's going to be the hit that the market is pricing in right here, and you're seeing it in yields.
I think we also have to talk about politics because, the Biden bounce, clearly that was good for stocks today. How much of it was that? We don't know exactly, but that's been out there.
I'm just glad his last name isn't Selden. Biden is way better, way more appropriate.
Right.
You have to look at big events. To the point that you're making, I think is spot on. South by Southwest, is that happening? That affects corporations, tons of people, all kinds of travel, the hospitality industry. So far, still on. Let's hope, right? Coachella right afterward. These are some of the things that I completely agree. Those types of headlines, they might not trigger people to sell, but the algos are going to go nuts.
Question for you, Josh. Even if we don't see that type of economic restrictions here in the US, what if China's GDP for Q1 and Eurozone GDP for Q1 is significantly worse than people expect? Does that spook the US market or not? Do we have to see something majorly hit economic activity domestically?
I think it could. Like Italy, nobody's expecting anything from economically. I mean, I hate to say that, but Italy, China, yeah. China's the ball game. So, yes, I think that's absolutely something that people are paying attention to.